Hi there, ladies and gentlemen, and welcome to our alternative series for 2024. My name's James Marley. I'm a co-founder at Livewire Markets, and today I'm joined by Stephen Darke, who's the CEO of ASX-listed Navigator Global. Stephen, good to meet you.
Good morning, James.
Not many people would be aware that Navigator is a pure play alternative assets manager listed on the ASX. It has exposure to a bunch of underlying alternative managers, most of them offshore. So we've been learning a little bit more about the opportunity in alternatives and how Navigator's business is operating. So, Stephen, I've given a quick intro there, but maybe for people that aren't familiar with Navigator, tell them a bit about the business.
Sure, thanks, James. So Navigator owns equity interests in 11 alternative asset managers globally. One of them's here in Australia, Longreach Alternatives, but most of them are overseas. And these managers across all of our partner firms, which is what we refer to them as, manage over $100 billion of assets. And that's spread across the portfolio. It covers strategies like leading hedge funds globally that are established, as well as private market and public market firms, private credit firms, real estate capital solutions, and some commodity strategies.
Yeah. Now, you've been in the role coming up on 12 months. How'd you get involved and what's your background? What do you bring to the table?
Sure. Yeah, no, thanks. Well, yes, you're right. It's 12 months next week, actually. And at that time, when I was sort of joined Navigator, I had been working in my own advisory firm where I was advising small asset managers as to how to grow, sort of advising them on things like succession, valuation, how to pay their people, how to think about distribution and product development and strategy. But before that, that little business was called Arch Advisors. But before that, I spent 23 years at Macquarie Group. First half of that was in the investment bank, and the second half was in the asset management group. And almost all of the last half of it was really focused on alternatives. And I spent that time in London, New York, and Sydney, but mostly in New York. And we had the opportunity during that period to establish 11 alternative managers from all the way back from 2005. And so I've had sort of a long experience in what goes right in alternatives and what can go wrong, and actually really enjoy sort of supporting and helping entrepreneurs in the alternative asset management grow their businesses. And before then, I was a lawyer at Allens in the late 90s.
Okay, there you go. You mentioned things can go right, can go wrong. What did you learn?
Yeah, well, I learned, it was when we hit the GFC, we actually had almost all of our capital deployed in a private equity fund, establishing these managers. And what I learned was, sometimes trades can go wrong, and sometimes things just don't work, and sometimes the capital taps can get turned off and you can't fundraise for strategies. And it's those sorts of volatile markets where you find out how people manage money and how they can deal with risk and volatility, and also how good they are as partners. And you've really got to do your diligence up front. You've got to work out that when trouble hits the fan, are you really prepared as a partner with these asset managers to be able to work with them to get through those troubles? And it really is a test when those things happen. In investing cycles, it's not a question of when, not a question of if, it's a question of when. So these are people businesses, and it's not like buying a gas pipeline, but you've got to be very careful about how they deal with their people and how they think about risk and return.
So tell us about the managers that Navigator has partnered with. Which strategies sit underneath or under that umbrella? And importantly, how do you select them?
Yeah. Well, good question. Let's start with sort of the strategies. I'll start with the local one. Longreach Alternatives, run by Sam Mann and his team here in Sydney, is a $3 billion alternatives business. We have strategies on that platform that include private credit, which is very topical now in the Australian market. Also, oil and gas strategy, an agricultural strategy, and other strategies, including the fundraising they're doing right now for a royalty fund that the Partners Group principals founded, as well as a leading European mid-market private equity strategy called Pantheon. And recently we actually bolstered the fundraising and development team at Longreach because those strategies we expect will garner a lot of investment and appetite in the Australian market, and we can talk about why that is later. In terms of the global strategies that Navigator owns, it includes some of the world's leading hedge funds, and in particular, or just to pick out one, CFM is probably Europe's best quantitative multi-strategy firm. We own alongside the founders and the only equity stake in that firm. And also Waterfall, which is one of the leading structured and private credit businesses out of New York, Very proud of those, Jack and Tom and what they've built with that platform. Both of those strategies, by way of example, have $20 billion under management each, and they both sort of yield, alternative asset management fee yields, which we can get back to that shortly. So that probably gives you a snapshot of a couple of the managers. Some of the others are, managers like, there's a manager called Marble in the US. It's very similar to a Qualitas, for example, here. Yep. And there's a manager called Invictus out of Washington that's similar to a Latrobe Financial. So we're very proud of our partner firms, and they really exhibit a lot of the strategies across alternatives. Having said that, there are some aspects of the alternatives universe that we are yet to properly invest in, and we're seeking new partner firm investments with our balance sheet to be able to do that.
And on the selection criteria, what are the main hurdles they have to clear for you?
Yeah, well, before I get to that, I just realised I didn't answer your second question, which is how we actually do it, and then we'll get to the criteria. I think in terms of how we do it, I was fortunate during the 12 years in New York to build a good network of contacts amongst the industry. At the end of the day, it's not a large industry. It is growing very, very rapidly. But from 2006 to 18, built out a lot of New York contacts. My chief investment officer of Navigator is based there. He's very well connected. So we have a proprietary relationship of sort of sources and managers. We're also very well connected with the global investment banks and boutique investment banks that sort of play in this space. And so some of the deals are intermediated in terms of acquiring these asset management stakes. And then finally, I think in terms of Blue Owl, who's our strategic partner in this business, they own over 50% of Navigator stock. They really, because they see almost all the asset managers in the world that come to them, they've done over 60 deals since the global financial crisis. They sort of partially vet and refer to us some transactions that maybe we haven't seen. And we value that as a very strong relationship. And to the extent managers are too small for them to invest in because they've got very large funds, then we have a chance to independently evaluate whether they are investments for the Navigator portfolio. On the criteria, well, how long have we got? Not enough time, but the sort of things we are looking for is, can we really see that this manager has a particular edge? Like, do they have an edge that compared to their peers, they've been able to really attract and generate a risk-adjusted return over multiple investment cycles? And if so, why? How have they done it? Because not everyone can do it. A lot of people say they can do it. What is their criteria? What about their pedigree and experience gives them the ability to generate that alpha? But also it's more to do with what's the structure of the firm? Have they passed equity around the firm to make sure that the succession risk is mitigated? What does their fundraising team look like? What's the growth trajectory of their business? And do we think investors are going to continue to give them money? And so we do an awful amount of diligence at the front end, and we're looking for those sorts of criteria, and obviously many more. There's also particular geographical areas and also particular strategies that we are seeking, but we generally start with the people and the first and their strategy, and then we think about the rest of it, and that sort of bolts onto an attractive story.
Well, let's talk about growth. Where are you seeing growth in alternative assets?
Well, look, it's globally, and you see in the AFR every day, certainly private credit here domestically. We are a global firm at the moment. For example, in our pipeline, everything is outside Australia. North America continues to be the bedrock of growth. They have been, in the alternatives asset management space with the depth of their capital markets far longer than anyone. We do like certain strategies in Europe at the moment. I think also there's an opportunity there in things like distressed credit. I think in the US, there are strategies like secondaries, and for your viewers that don't know what that are, is like strategies by managers that come and acquire private market stakes in the secondary market, typically because the investor that owns that locked up capital wants to sell it. They want liquidity and they can't find it. Secondaries managers are really attracting a lot of AUM right now, and I suspect that trend will continue. Just on private credit, the banks are pulling back from risk, and they're pulling back due to regulatory reasons globally. It's continuing in the States. It's here as well. As a result of that, you see really attractive private market firms step in and provide that capital. And so we are looking very closely at more of those sorts of firms that we think are quality managers. So, that's some of the strategies we like. We think hedge funds have been unloved for some time. Despite that, the Navigator firms have grown, although in the last year or so, it's been more difficult with muted growth. It's a challenging fundraising climate, but we believe that's going to change. I think it may change slowly, But if you have a look at the markets right now, even frankly in the last few days, you're seeing volatility with the Middle East, you're seeing geopolitical, you're seeing political volatility out of the US, and you're seeing increased volatility and dispersion in the markets as a result of rates. So what does that mean? That means that quality managers that are trading that sort of risk and those factors are able to generate alpha, and we believe the top hedge funds will regain their growth profile, and Navigator's very proud to have a number of those in their portfolio. So I think hedge funds are a place which in the short to medium term you'll see capital move back into after having been somewhat absent. I think there's areas of challenge though. I think if you're a private equity manager and you haven't had a lot of realizations or can't show your distributed proceeds in attractive returns to investors, I think it's difficult fundraising. I think the current vintages will be good, but it's going to be hard on the fundraising front. And then I would say there's challenges in venture capital. I think there hasn't been a lot of capital. If you've been invested in VC in the last 6 years, you haven't seen much money come back. So I think those managers are going to continue, there's always exceptions, but continue to struggle to raise money.
Yeah. You touched on you talked a lot globally there, private credit, you talked about hedge funds. Are there any trends that you see offshore that you think are likely to come to the Australian market over time?
Yep, I do, and you're seeing some of it, so probably not rocket science again for your viewers, but there's this, I don't like the expression, but this democratisation of alts. In other words, there is an increasing acceptance by family office investors, wealth platforms, that perhaps locking up your capital for a little bit longer can really allow you the opportunity to get really quality risk-adjusted returns. So you're seeing, family offices and wealth, and also the product development of products that are a bit more focused on retail investors and wholesale investors and high net worth investors. There's been innovation on that front. As a result of that, the taps have opened a little bit more into the access into alternatives by those types of investors. And I think that's going to continue at a very fast rate of knots. And you're seeing that through the various wealth platforms here in Australia. And you're also seeing, because of the increased tolerance of investors for that illiquidity risk, and they're prepared to be patient to get higher returns that are differentiated from what they're getting from the equity markets, that you're going to see a lot more foreign GPs or international GPs come to Australia. And I think that's going to happen in two ways. They'll set up shop here, or indeed they will set up, use intermediaries to sort of raise more money from
distribution style.
Correct. Yeah. And as a result of that, that's why, certainly worked with Longreach to build up the Longreach Capital Advisors business, which is now headed by Andrew King. Yeah. So I think those sorts of trends are the case. Private credit, you read it every day in the paper. I'm not a private credit expert. I will say this, that there are a lot of managers starting, and really for those investors looking to invest in those firms, pay a lot of attention to how these managers underwrite their risk and how they think, whether they've actually invested across cycles and times of trouble, because there hasn't been trouble in Australia for a long time. Do they have the pedigree to be able to do they have the resources to underwrite the credit? I'm not suggesting there's trouble in private credit, but whenever you see a supply of capital going to the market, you have to make sure that doesn't cause underwriting concerns.
Stephen, a couple of questions on Navigator and the business. What are the opportunities that you see to grow Navigator from where it sits today, 900 odd million market cap? What's top of the list for you?
The top of the list is seeking and identifying and executing on new partner firm investments. I mean, without going into what's happened in the last year, we had this. It was a real growth catalyst for Navigator. It was an architect before I joined, but certainly we did an equity raise earlier this year that cleaned up Navigator's balance sheet, that now gives us increased operating cash flow. We printed 90 million US EBITDA, which is pretty much going forward all cash flow. And we're able to use that cash flow as well as our balance sheet and our undrawn facility to acquire new managers without tapping the equity markets. This is great. It's great for our shareholders because it's not dilutionary. I think that we are seeking partner firms. We have about 4 or 5 in our pipeline. As I said earlier, they're all offshore because we're looking for high quality pedigree firms with quite a big growth trajectory. They're hard deals. And there are transactions that we've passed on because people have overpaid, in our opinion, or there are transactions that the vendors decided, the management teams decided they didn't want to sell a stake in, and they were probably quite right. And this is what happens in these sorts of business. So we're excited about the opportunities in front of us and deploying our sort of a capital of our shareholders in great ways. And I'm looking forward to announcing a deal, but we're not an M&A roll-up business. So unless the team and I identify something that really makes sense and diversifies and makes our portfolio more resilient over the longer term, then we won't do the deal. But that's certainly one of them. I also think that, and it's great to be on Livewire, I also think that the market engagement, I mean, the prior CEO before me was based in Florida. Happily, he's still in the business. He stepped down really to run the business that he founded called Lighthouse, which has a number of great strategies. It manages just under $16 billion US. Sean and I speak every week. I think he's now focused on that, and I'm focused on this, and I need to continue to improve the market engagement so the market understands the quality of the firms and what Navigator is really about. Because being, as you said earlier, the only listed ASX stock that has 100% of its revenues attributable to alternatives is an incredibly powerful thing, and I need to do a continued and perhaps improved job in explaining the business model in a simple way.
I took a look at your deck from the latest result. One of the things that caught my eye was it seemed like FUM growth was muted for a part of the market that's attracting so much attention. Is that a fair comment?
It is a fair comment. It's also true that our AUM in the last 12 months went up by 5%, but as I pointed out on the earnings call and we talked about it, that was all due to investment performance. So on one side you say, well, that's great, the firms are all performing well, which they are, but where's the net inflows? There is, as I said earlier, a muted fundraising environment out there for some strategies. It's hard, I think, for Australian investors to perhaps see that when they see a lot of inflows into a number of managers here locally. From my perspective, the reasons for that, a number of our leading managers have large institutional clients. It's a little bit lumpy and it takes more than one sales cycle for these investment accounts and to come in. Also, you can have a couple of idiosyncratic redemptions, which we had. It's not reflective of our overall portfolio, and I expect to see those managers return to growth. The earning drivers of Navigators, unlike, I would say, almost every asset manager, are not around net inflows. Because we make the sort of fees, or our underlying managers make the sort of fees that I outlined before, we make over $3 for every $100 of revenue we get. The fees are more around the operating margins of our businesses and our performance of our business. I'd love to see those flows come back. I think we will, but it isn't a driver of our firm's earnings.
Okay. Question to wrap up.
Yep.
I know you and your fellow directors have been buying stock in Navigator on market. Would you rather own Navigator shares or invest in the funds that sit underneath the portfolio? Yeah,
well, first time I've sort of been asked that question, James. First of all, yes, I do buy whenever there's a window. One of the challenges about being in the management team is that you've also got to make sure you don't know anything that the market does. So they're very limited windows and I need to be permitted. But yes, I buy whenever I can. The answer is both, probably not surprisingly, but let me explain that a little bit more. They offer very different risks. So when you invest in alternative funds, and I do that as well, usually you would expect a high single digit to a high double digit net return, depending on whether you're investing in sort of credit-based defensive strategies up to private equity style strategies. You typically will have to lock up your capital for a period of time, and you typically get the return of the underlying pool of securities of which you're invested. An investment in Navigator, for example, gives you indirectly an ownership stake in the actual asset managers. So you are buying a share of the fees that they're receiving, not paying. And so that provides a much higher return profile. And when we're looking at underwriting managers, over time, we're looking for returns well, in excess of what I just said, into the 20s. But it takes time for that to play through to the stock price. So I, buy Navigator for a different reason. You're buying a share of equity, equity in alts managers. Because it's a small caps though, it has higher volatility. You see that on the market, but you also get daily liquidity. So it's one of those toss-ups, and I certainly am invested in both, and I'm happy about that.
Okay. Well, Stephen, thanks very much for coming in today and telling us a bit more about the business and what you're seeing in the alternative space.
Thank you, James.
Ladies and gentlemen, I hope you enjoyed that interview with Stephen Darke. Remember, this is part of our alternative series. We've got plenty of fresh content hitting our YouTube channel and the Livewire website.